You have money in the bank. More than you've ever had. And somehow, you're falling behind. That's not a feeling. That's math. Right now, the average American savings account pays an interest rate of about 0.46% per year, according to the FDIC. The inflation rate over the last decade has averaged roughly 2.5% per year, and in 2022, it briefly spiked above 9%. Some years it runs higher. Some years it cools. But over any extended period of modern economic history, inflation has moved in one direction, up. Do the math and you get a gap between what your savings account is paying you and what inflation is quietly taking from you. That gap is not zero. That gap is not small. That gap, over 10 years, over 20 years, over 30 years, is the difference between financial independence and financial stagnation. You don't see it. That's the cruel part. Your balance goes up every month. Your deposit lands. Maybe you add a little more when you can. The number on the screen gets bigger. But the number on the screen is not the real number. The real number is what that money can buy. And that number, in terms of actual purchasing power, is going down. This is called inflation erosion. And it's been working quietly against your savings for your entire adult life. Let's make it real. In 2000, $1 could buy roughly what $1.76 buys today. That's according to the Bureau of Labor Statistics CPI calculator, a government tool that tracks exactly what prices have done over time. If you had put $10,000 into a standard savings account in 2000 and left it there for 25 years, you might have around $11,500 or $12,000 today, depending on the interest rates of the era. But the buying power of that $12,000 is less than the buying power of your original $10,000. You saved for a quarter of a century. You were disciplined. You were responsible. And you still came out behind. That's not bad luck. That's what happens when you use the wrong tool. Think about a gas tank. A savings account keeps your money safe, contained, protected from theft. But it doesn't fuel anything. The car doesn't move. The gas just sits there. And every year, a small invisible process breaks down the fuel molecules very slowly, until the tank is technically full but the car has lost range. That's your savings account. Full by one measure. Depleted by another. Here's what no one explains when you open your first savings account at 22. A savings account is not an investment. It is a holding area, a parking lot for money you're going to need soon. Not soon meaning in 10 years. Soon meaning in the next few months. Banks are transparent about the math. If you look closely, they take your deposited money and lend it to other customers at rates between 6% and 25%, then pay you 0.46% for the privilege of using your money to do so. The spread between those two rates is the bank's business model. Your 0.46% is not a reward. It's a licensing fee for access to their infrastructure. Now here is the part that actually stings. While your savings account has averaged less than 1% in interest for most of the last 15 years, the S&P 500, a broad index tracking the 500 largest publicly traded companies in the United States, has averaged roughly 10% per year over the last century, including dividends reinvested. That's not a cherry-picked number. That's the historical record, cited extensively by researchers including Yale economist Robert Shiller, who has tracked real market returns back to the 1870s. Shiller's data shows that over every 20-year period in modern history, the real return of the broad U.S. stock market has been positive. Not most periods. Every period. So what does a 10% average annual return actually do when you give it time? This is where the math changes your understanding permanently. Say you have $10,000 today. Put it in a typical savings account earning 0.5% per year. In 30 years, you have about $11,600. In 3 decades of discipline, of never touching it, of watching the number quietly tick upward, you added $1,600. Now put that same $10,000 into a broad market index fund, a fund that simply tracks the S&P 500, buying tiny fractional shares of 500 companies automatically, all at once. At the historical average of 10% per year, compounded annually, in 30 years that $10,000 becomes approximately $174,000. Same starting money. Same 30 years. The same discipline of never touching it. The difference is $162,000. And the only thing that changed was where you put it. This is compound interest, the idea that your returns earn their own returns, and those returns earn returns, and they stack on top of each other until the growth curve bends almost vertically upward. It is, as Albert Einstein was once said to have called it, the eighth wonder of the world. He may or may not have said it. But the math absolutely does. The savings account does not compound in any meaningful way. The difference between 0.5% compounding and 10% compounding is not a difference of degree. It is a difference of kind. One produces a barely growing line. The other produces a curve that accelerates beyond recognition. And here's the counterintuitive part that most people get completely backwards. The savings account feels safe. The index fund feels risky. But when you zoom out to 30 years, which is the real-time horizon of retirement, of financial independence, of building anything lasting, the risk calculus completely reverses. The savings account has an almost guaranteed outcome. You lose purchasing power slowly, steadily, and invisibly every year, with almost no chance of keeping pace with inflation, and no realistic path to growing real wealth. The index fund has volatility, years where the market drops 20%, or 30%, or 50%, but its long-term trajectory, across every 30-year rolling period in modern U.S. financial history, has been steeply, dramatically positive. Every single one. The thing sold as safe is the actual risk. And the thing that feels risky, when measured across the only time horizon that matters for wealth, has been the only reliable answer. This isn't a fringe argument. Jack Bogle, the founder of Vanguard and the creator of the first index fund available to everyday investors, spent his entire career making exactly this point. Bogle launched Vanguard's first retail index fund in 1976. He was mocked. Critics called it Bogle's folly. Today, Vanguard manages over $7 trillion in assets, almost all of it in low-cost index funds. Warren Buffett, when asked what should happen to the money left to his wife after he dies, said it should go into a simple S&P 500 index fund, not his own stock picks, not a hedge fund, not anything sophisticated. A simple, boring, automatic index fund. These are not obscure people pushing an extreme position. These are the two most celebrated investors of the modern era pointing at the same boring answer. Why don't most people follow this? Why does the savings account win by default? Because of how your brain is wired. Behavioral economist Daniel Kahneman, who won the Nobel Prize in Economics in 2002, showed that humans feel losses about twice as intensely as equivalent gains. A market that drops 10% in a month triggers alarm. A savings account that loses 2% in purchasing power every year triggers nothing, because the number on the screen never goes down. You can't see inflation in real time. You can see a market dip in real time. So the invisible, slow, certain loss feels safe, and the visible, volatile, historically profitable investment feels dangerous. Your brain is using the wrong signal. And the money market account? The high-yield savings account now offered at 4% or 5%. These are real improvements over the traditional 0.46%, and you should absolutely use one for your emergency fund and short-term savings. But even 5% compounded annually over 30 years turns $10,000 into about $43,000. Versus the historical index fund result of $174,000. A high-yield savings account is a better parking lot. It is not a wealth-building engine. Here's the test. Look at the money in your savings account right now. Ask yourself one honest question: when do I actually need this money? If the answer is within the next 6 to 12 months, keep it in the savings account. That's exactly what it's for. Liquidity. Immediate access. An emergency fund covering 3 to 6 months of expenses is a genuine financial foundation, not a luxury. But if the answer is I'm not really sure, or probably not for years, or this is money I think of as savings for the future, that money is being eroded. That money has better options. A Roth IRA lets you invest up to $7,000 per year in index funds, and your growth comes out completely tax-free in retirement. A 401k lets you invest pre-tax dollars, reducing what you owe the government this year while your money grows for decades. These aren't advanced instruments reserved for wealthy investors. They're accounts available to almost any working adult, designed specifically to put the compound growth engine to work in a tax-efficient shell. The barrier isn't access. The barrier is that no one explained the difference between a place to park money and a tool to grow it. You have money in the bank. More than you've ever had. And now you understand that the number on the screen going up is not the same as your financial future going up. One is arithmetic. The other is freedom. And they run on completely different math. The savings account is not your enemy. But it is not your ally for building wealth. It is a waiting room. The question is how long you plan to stay. The math is patient. Inflation is patient. The compound curve is patient. The only thing that isn't patient is time, and time, once it's gone, does not come back. You have money in the bank. More than you've ever had. Now you know exactly what to do with it.